Hey everybody, Chuck Barone, Tuesday, October 11th, 2022. We're off to the races this week with more crazy, world-rocking, nutso events. It's just amazing what this news cycle is like these days in finance, and not only in finance, in the world and society. It's just a crazy, weird world we're living in, man. Nice to have some normal people every day. As always, we want to thank all of you guys for your support for the channel and for watching the videos and all you guys do every day. We really, really appreciate your support, guys. Couldn't do it without you. In the markets today, well, there's a lot of data coming up later this week, so the markets are kind of not quite sure which way they're moving. The stock market mixed today with the Dow eking out a small gain. The NASDAQ and S&P both down. S&P looking at a 5-day losing streak. Not a happy day in the stock market. The bond market down again too. This is, the bond market's in a pretty nasty bear market right now. The 10-year sitting at 3.94%. I think this matches the peak it just hit a little bit ago, creeping its way up to that 4% number. The 2-year sitting at 431, so the inversion narrowing now. Now it's down to 37 basis points as the rate on the 10-year starts to creep up faster. Bond market now looking good. Be very cautious investing. If you're going to buy bonds, stay away from bond funds. If you buy the bond, even if the rate changes and the value does, if you hold the bond to maturity, you get made whole. So it might take a little bit of patience, but you're not going to suffer any kind of real loss as far as your principal amount. The dollar today up, small amount, but still up again. Over 113.25 on the index. It's just right now kicking the crap out of everything in the world. What this is, let me just give you guys a real quick explanation of why the dollar is so strong. It's because the Fed has moved much more aggressively raising rates than the rest of the world has, right? In Europe, they're barely over 0%. We're sitting at, 3 point, whatever it is, 3.25-ish roughly. We got a lot more to go. The Fed has really been super hawkish, which then puts more steam into the dollar. The other world governments and central banks are not raising as aggressively. The ones that have, they're not really getting smashed as hard by the dollar. The ones who haven't, euro, yen, hello, getting the crap knocked out of them. So that's kind of why the dollar has been as strong as it has and continues to be strong, is because the gap between where our rates are and where the rest of the world's are. So they need to start catching up with rates. But apparently right now it looks kind of like the Fed's being super hawkish about this inflation. The rest of the world, not so much, and that's creating a ton of strength in the dollar. Like we've been saying for a long, long time now, dollar strong, metals weak. Gold down $2.60 today, sitting at $16.67. Silver down 46 cents, sitting at $19.23. Truthfully, I'm surprised they're even holding these values with the dollar where it is, and with the way the dollar looks like it's going to be up there for a little bit. Metals holding on, doing okay. The oil today down almost 3% today, 88.53 per barrel for West Texas Intermediate. So much for OPEC plus. There's a supply side, and they're trying to cut that. There's also a demand side. It looks like for some reason they're guessing demand's going to go down. Yay, China. And knocking the price of oil down today. Natural gas up today, 2%, sitting at about $6.50 for their million BTU. Natural gas has come down quite a bit. I think it was sitting at $9.30. So go figure, guys, right? Bitcoin down today, barely holding the 19,000. Looks like it's going to probably break through that and test the 18.5 support number. Things not looking great for Bitcoin. I think it's looking for a reason to move down, and it looks like maybe it's going to find it. Again, moving with the S&P 500. Today, in economic news you guys need to hear about, well, the only real report today was the short interest report. Now, it was interesting, though, because short interest means people who are borrowing stock and selling it, hoping to buy it back at a lower price and make their profit that way. That's short selling, right? Well, right now, short interest and the short interest ratio is near the all-time high. So everybody, these big traders, I'm guessing private equity groups, hedge funds, and a lot of big players in the markets, betting pretty big that the stock market's going to go down. It's the highest the ratio's been since 2007, 2009. And we all know what happened to the stock market back then, right, guys? I mean, this is a pretty good indicator of what's going to happen with the market. There's been a lot of other stuff coming out about market. I think we can expect this correction to start picking up some steam. It's going to be a long, however much is left of this year and plus into maybe all the way through next year, going to be a long stretch for the market where there's just not going to be a ton of terrific news, even though their earnings are decent. A lot of companies doing pretty well earnings-wise. Employment's strong. Companies still want to hire, even though they keep threatening there's going to be layoffs. We're not seeing it. Interesting stuff. Interesting. But anyway, hopefully, if you're in the positions we've been recommending, if you got your portfolio dialed in to a defensive position, utilities, healthcare, dividend-paying stocks, preferreds, about 10 or 15% of your portfolio in precious metals, you're looking okay right now. You know, you're not getting pummeled by this market as much as if you had, stayed in growth stocks and stuff like that. But hang on, guys, because this is going to be a tough sledding here. Also in economic news today, the Central Bank of England in the news had to get back in the markets to support these pensions, to support their gilts, which is what they call their bonds there for the UK. Now they're warning, they're really getting kind of huffy about this because they don't want to be in this market very much, it doesn't look like. So they're warning of a material risk to financial stability. And the interesting thing about this ECB buy into their debt markets, it ends this Friday. So the president of the ECB was in the news today warning these pension funds they have till Friday to get their stuff in order, because after that, now we'll see. Talking tough is one thing, actually following through something else completely. You know, will they let these pension funds take these colossal losses, get these margin calls started up and start this cascading effect where it starts rippling through the markets, the derivatives market and everything attached to all of this stuff, force them to sell bonds into a crashing bond market? I mean, it's just, we'll see. It's, we got some fascinating, as crazy as it's been, all of this is telling us it's about to get even crazier. I don't know if it's time for Prozac or a good, a nice good scotch or whatever, but hang on, guys, because the crazy world is fixing to get a whole lot crazier. Today, housing, I think there's a really, I've been talking about housing and real estate. You guys know I'm in the industry. I think that there's a disaster coming, depending on what your definition is. I see a pretty big decline coming, 20% roughly, from where we are now. And interesting information today, the Housing Affordability Index came out, Case-Shiller, and it is at its lowest level ever recorded. Houses have never been more expensive. Affordability has never been a bigger problem. People can't afford to buy houses. That's the American dream, guys, right? Owning your own little piece of the world. Not good stuff. They're saying that rates will probably be persistently high. And they're projecting that rates will only fall from where they are now, which is about 7 1/8. They're going to get down, they're saying by the end of next year, they're hoping to have rates back down to about 6 1/2. Well, if they keep rates that elevated for as long as they have been now, that would be about 1.5 years. I promise you by the end of that 1.5 years, real estate prices are going to look a lot different than they do today. Got a little bit of a problem with that though. Because, listen to this, this is really interesting, guys. It said that the average person holding a mortgage right now, the average person having a mortgage has a rate averaging 300 basis points below the prevailing rate. Holy crap, man. So that means people have 3% cheaper mortgages they're holding, or more, in a lot of cases, than the prevailing rate is today. So what motive do those people have to sell that house? To refi that mortgage? It's just going to make it a lot. That's going to crimp, I think, the supply side a little bit, because with prices where they are, if you sell your house, you still have to buy something else. You have to qualify for a new mortgage that's 3% higher than the rate you have now. You're going to get less house and pay. Like if you sold a house that you bought for $400,000 10 years ago, well then guess what? You sell it for $6, let's say, just to use an easy number. Well, your $6 isn't going to buy as much now as it did when you bought your $400,000 house. It's going to buy you basically what your $400,000 house was. So there's just, real estate has got some issues coming that are going to be really, really tough to fix. Here's another interesting thing. They said that only 6% right now of U.S. mortgages are adjustable rate mortgages. And that was the big thing in 2007, 2008, 2009. People had adjustable rate mortgages back then, all that subprime stuff that everybody read about. Well, all of those loans, pretty much all of them, the vast majority, well under the 90%, were adjustable rate. Now, they all had a fixed rate to start, 2 years, 3 years, and then after those 2 years or 3 years were up, the idea would be you would refi out of it to a fixed rate program, and you wouldn't be dealing with the adjustable rate part. And it worked for a long time till house values started to decline. Now they didn't have the equity to refi, and they got stuck in adjustable rates. But anyway, that will not be a factor now. People will not be forced to sell their houses. People will not be forced to move. They're not going to get payments that are escalating all the time. So it's going to be a very, very, very interesting thing to see how all of this works out in real estate as well. So we got big messes everywhere, guys. We got the federal government with their $31 trillion and half $1 trillion a year in debt payments. We got the stock market and Wall Street going all crazy. Stocks in a bear market, bonds in a bear market. We got inflation, the Federal Reserve in the markets. We got the whole world teetering on the edge of recession. We got wars going on. I mean, I guess the only good news that I can think of is the Bills are winning, right? I mean, the world is off its frickin' rocker, guys. They said that the home buyer sentiment, the Case-Shiller sentiment, collapsed all the way down to 60 on the index from over 85 in the past 6 months. So 6 months ago, people wanting to buy houses, excited about real estate. 6 months later, kaboom, lowest level ever recorded. Crazy stuff. To finish up the show, though, just a couple of odds and ends here. The Atlanta Fed Tracker, which we go by to get an idea of where GDP is coming in for the quarter, now shows they're expecting the third quarter GDP to be up 2.9%. It's crazy, man. I mean, a lot of people will say the number's bullshit, and it very well may be. But it can't be that whenever they report a bad number, that's the gospel. Don't believe me, even the government says it. But whenever they report a good number, it's absolute bull. It can't be, right? You see what I'm saying. So interesting thing there, because what would that do then? Do you have to have 2 consecutive positive quarters to be out of a recession? It would really throw a kink in the works as far as like the Fed rate increases doing dramatically bad things to the economy, because they're not, at least according to the Atlanta Fed Tracker. And you have Fed President Meester of Cleveland today out in the media. They keep parading these Fed yo-yos out in front of us to say crazy stuff and spook the markets, which you're very good at. And she was saying that as it stands, the Federal Reserve has made no progress as far as bringing inflation down. So she's super hawkish about rates. She said that they may actually have to exceed their target, which is 4.5 to 4.75. That they're going to have to rates will have to remain elevated for an extended period of time to get this inflation under control. It's just her language was as hawkish as I've heard from a Fed president, and they've all been very hawkish, talking up rates. I don't know, man. I would certainly rather believe my eyes than what they're saying. And but truth is, what they've been doing is what they've been saying they're going to do. So we'll see if they keep on that track. We got a bump coming up next month of 0.75. That'll be another shock to the system. Another bump in December of 0.5 point. That'll get them at their target for the end of the year, around 4.5%, just a little over. It is going to be a wild ride, guys. And to wrap things up today, I love this further signs of the impending apocalypse. I just had to make a comment on Ben Bernanke getting the Nobel Prize in economics. I guess they're giving Nobel has run out of economists to give the prize to. This is the guy who's the king of pumping up the money supply, the creator of QE. This is a guy who's basically his policies have landed us where we are now, with the whole world about to freak out, and they're going to reward him with a Nobel Prize. I don't even know what to say to that. It's just crazy. I keep using the word crazy, and I apologize for that, but I got to say, I've been watching these markets since the 80s. I've been around a long time. I've never seen things as upside down as they are right now, especially across this broad spectrum of everything. Guys, hunker down, man. The storm is here. It's going to keep getting crazier. Now it's a worldwide event. We get to watch how it's going to play out in other countries as well, partners and enemies alike. Nutsoville, man. We're in it. We're living it. And let's stay together on this one, guys. It's going to be, if you're in the right position, and you're going to be okay through this, and hopefully if you've been listening to what we've been saying, you are in that position, it's going to be something amazing to watch, because there's so many ripples. How they say you drop the pebble and it ripples? Everything that's happening causes its own set of ripples, so there's ripples on ripples. It's weird and crazy times. We're going to be here to talk about it with you guys every day. We'll be back again tomorrow. Big data starting tomorrow and Thursday. PPI numbers tomorrow. Till we talk then, guys. Take care. Thanks.